Welcome everyone to today's webinar on new liquidity reporting standards. And before we get started and I hand it off to folks at NACD, I do want to go over a few housekeeping items. So I definitely want to make sure that you know that you can minimize or maximize the webinar pane during the presentation by using the red and orange arrow buttons. And during the webinar, we definitely encourage you to ask questions. So there's going to be a questions box where you can type in your questions, and our presenters are going to be answering throughout the presentation and at the very end as time allows. And then I definitely want to make sure everyone has good audio settings. So if you're on a telephone, make sure you select the phone call audio option. If you're on a computer, make sure you select the computer audio option. And if you're joining us today for CPE, just a few reminders, you need to make sure that you're on a personal computer with no smartphones and logged in using your own unique URL, and you need to be logged into our software for at least 50 consecutive minutes and actively respond to at least 75% of the polling questions. And make sure you also complete the evaluation survey at the end of today's webinar. And then just as a quick reminder, you will get a link to the presentation and recording of today's webinar within 24 to 48 hours. And then today's learning objectives are review issues most relevant to board members, understand the nonprofit reporting model changes, and analyze recent changes, ongoing FASB updates. And with that, I'll go ahead and pass it off to Elizabeth.
Thank you so much. This is Liz Fetter, and I am a member of the Board of Directors of NACD NorCal, and also am the finance chair and the treasurer of that organization. I've been served on a number of both for-profit and nonprofit boards over the last 25 years or so, and I'm delighted that you are all joining our webinar today on the liquidity reporting requirements for nonprofits, sponsored by NACD and Armanino, who are our subject matter experts for the day. So let's, without further ado, kick off, and I will turn it over to Dean, who is a partner at Armanino, to get us going.
Perfect. Thank you, Liz. Actually, what I'm going to do real quickly is just introduce Dean and Stacy a little bit. Just FYI, Dean is a partner here. After spending 12 years as an auditor, he transitioned to be our chief relationship builder for the firm. He's helped numerous private and public nonprofit companies address their tax, audit, and outsourcing needs. And then we also have Stacy, who's been with us who has at least 14 years of experience in public accounting and specializes in nonprofit organizations, higher education, social services, healthcare, and religious organizations. And she has extensive experience providing single audit services. And actually, I'm going to have Stacy start us off.
Great. Well, thank you, everyone. Thank you for the introduction, and happy to be speaking to you today on a topic that has been very, very, very important and at the top of everyone's list, and especially all of the board members that are stakeholders and constituents in nonprofit organizations and nonprofit financial statements too. So we're going to talk a lot today about one specific element of the nonprofit reporting model standard, and that is the element of liquidity, which is a brand new disclosure that's going to be required in every single nonprofit organization's financial statements. So just before we get kicked off with that, just the slide that's up in front of you today, there were three other main components of the new reporting model standard that you've no doubt heard about. So changes to the presentation of net assets from 3 restricted categories down to 2. Some changes in how nonprofits are going to be reporting natural and functional expenses, and then options on how nonprofits want to present cash flow statement. So they can either choose to present the direct or the indirect method, where typically we've seen nonprofits using the indirect method unless they were a healthcare type entity. But as I mentioned before, we are going to focus on liquidity today because it is a brand new component to nonprofit financial statements that's required by this standard. So the key objective here, and I think that this is something that is really important and really relevant to board members. and especially, all of you who are on the call and on the webinar this morning, because really the objective of the liquidity part of the standard is to improve the quality of information that users of nonprofit financial statements have to assess liquidity and performance about nonprofit organizations. So that includes an analysis and an understanding of how nonprofits manage their risk, their liquidity risk, and their exposure to liquidity risk. And that analysis includes really diving deep into financial assets that nonprofit organizations have in their financial statements, and really understanding how those financial assets are going to be used, if they are liquid, if they're designated, reserved for certain purposes, all of those sorts of things that can change a reader's image of what they're thinking of, and what they're thinking in terms of performance when they're looking at nonprofit financial statements. So I think that this slide is really like kind of the key that sets the stage of what we're going to talk about today. And we'll get into specifics about what we mean by liquidity risk, and definitions of financial assets and things like that, so that you have a clear picture on some of those things. So Elizabeth, do you have any comments here to add from the board's perspective, just on the overall objective of the project, that could be helpful to board members before we get going any further?
No, I think you've covered it, but just to underscore that that our, the focus of this webinar is to make sure that from the board perspective, board members have the clarity to make sure that they ask the right questions when they're reviewing the nonprofit organization's financial statements before they go out. They have those top 3 items of most importance in their mind.
Yeah, and we actually, it's interesting. So this standard came out almost 3 years ago now, and so we've been talking to, and I'm sure Elizabeth, it's the same with you and your membership, but we've been talking about, to our clients and to the board members of our clients and prospects about how they should be involved in helping management, within their organizations review and even draft some of these disclosures, because the board members are a key stakeholder in nonprofit financials. And as we're going to get into a little bit more, it's so important for them to be knowledgeable and okay with what is included in these disclosures.
Right, and it's all, it really is all about asking the right questions, and what are the top risk areas for the organizations to bring those into sharp focus for management to focus on.
All right, so with that said, we're gonna do a quick polling question here before we get into details.
Perfect. And as a reminder, you need to answer at least 75% of our polling questions. Today we're going to have 4, so make sure you answer 3. So today's first question is, what is an example of financial asset? Investments, accounts receivable, prepaid assets, property and equipment, or A and B. So that's investments and accounts receivable. So we'll give everyone a few moments to put their answers in.
So we're kind of testing your knowledge here a little bit before we dive into some of the details, because these things will be the financial assets, and the definition of what comprises that will be important.
Okay, we'll go ahead and close the polls and show the answers.
All right, so it looks like the majority of you said it was A and B, and yes, so that is correct. So we're going to get into a little bit more details, but typically, financial assets they're an instrument where there's some type of contractual right to receive cash or other financial assets. They're usually also more liquid than other assets if you're looking on your balance sheet. So let's take a look at the next slide here as we move out of that polling question, just to give you some more examples in terms of what constitutes a financial asset for the purpose of this liquidity discussion. So basic things up here that you probably have thought of already and that we saw from the polling question. So things like cash, receivables, those can be accounts receivable if your organization has vendor type relationships or if you have earned revenue sources. They can also be contribution receivables. Investments definitely are financial assets. Deposits, depending upon what type of deposits they are. Inventory, and then other instruments like, for example, a lot of you probably have certain types of split interest agreements on your financials. So things like charitable remainder trusts, where you have some sort of interest in that example in the remainder part of the trust on the date of the donor demise. And split interest agreements can take several forms. That's just one example, but that is something that can be considered a financial asset. Things that don't fall into that bucket of financial assets are things like property and equipment, because there's really no, if you think about what your organization is doing, there's really no, sort of market or contractual right to receive cash. Any of the property and equipment that you have is used in operations, and technically it's helping to generate the revenue and to sustain the operations of the organization. So we don't really see contractual rights for those types of items. Prepaid items, so those are things, like prepaid insurance. Typically the cash has already been spent. There's not really any type of right there, again, that would result in a transfer of cash or other assets. Some nonprofit organizations can have other types of non-cash assets on their books. It just depends on what it is in terms of what classification it will fall into. And another thing that we're going to talk about today is what other liquid resources does your organization have available? So many of you, I'm sure your organizations probably have things like lines of credit, where you have liquid resources available to you should you need it. Some of you could be carrying balances on those, and some of them they're just there in case of emergency. But when we're talking about the entire liquidity analysis and specifically the footnote disclosure, it includes not only trying to ascertain financial assets that will be converted to cash or that will be utilized in a short-term period, but also resources that you have available. And the reason why, just to talk about another key here and a note of importance is that when the standard was when draft form, they had originally talked about having nonprofit organizations analyze both financial assets and financial liabilities for the purpose of this liquidity disclosure and analysis. And ultimately, what they thought is that really the analysis on the financial assets and the availability and the use of those assets was really going to be a key driver to identify what was going to be available, because the obligations of the organization in terms of things like accounts payable, payroll liabilities, things like that, those are going to be settled in the normal course of the operations. And so the FASB didn't think that it was important to include those types of obligations in the analysis, but rather focus on resources that were available and not restricted or designated for other purposes. Okay, so if we keep that in mind and we move on to the next slide, when we're talking about liquidity, we've set the stage, we've talked about what constitutes a financial asset. Now we'd have to, understand what scenarios could exist where these financial assets are not available. So there's essentially, when we're looking at nonprofit organizations and when we're analyzing why assets could be, either restricted, designated, locked up for certain purposes, we have sort of three classifications where, where those situations could happen. So really, it's dependent upon the nature of the financial asset, external limits, donor agreements, language in donor agreements, laws, contractual regulations, and then any internal limits that are imposed by governing boards. And this is all going to be important when we start getting into showing you examples of how you might want to think about constructing and going about your liquidity disclosure and analysis. because you'd need to really understand where the limitations are on financial assets and where they're going to be able to be used or not. So if we just like focus there on the nature of the financial asset for a brief second. So pretty routine things there. If you have, again, accounts or contributions receivable that are not going to be receivable in cash, where you're not going to get the cash within a year, within that near-term 12-month period, those are things where those assets are not going to be available for liquidity purpose. So a lot of times, like you'll have, your organization's going to have your long-term contributions receivable. Perfect example. If you've got a multi-year grant that's going to be payable over 5 years, years 2 through 5, that's not going to be liquid because you're going to be waiting a longer period of time for the cash to come in. On that second block there, if we just kind of look at limitations that are related to donor agreements, laws, and contractual regulations. So endowments are a really good example here. Because we've got, as you've got your endowments, and for those of you that have a large endowment portfolio, the corpus of those endowments are locked up and held in perpetuity. So your organizations can't touch the corpus. You'd have to look at any of the investment returns separate from the corpus, but that could cause a different presentation for liquidity purposes. And then if you've got other, we talked above about, contributions that are just restricted in terms of when you're going to receive the cash. But if you also have multi-year contributions or multi-year pledges that are going to be restricted for programs in future years, you'll have to take that into consideration too, because that the donor intends for you to use that on your programs. And even though you have the cash in the door, you may or may not the appropriation for the expenditure may or may not occur within that 12-month period. It could be further. So those are all things to keep in mind there. Some of you on, sort of some contractual and legal restrictions. Some of you have agreements or instruments where you have debt. You have debt service requirements or bonds that have contractual or legal restrictions attached to them that could really simple example, if you have collateral for debt. So collateral could be cash that's in a separate account. It could be in a CD, something like that. You can't touch that in most cases until the debt is paid off or, some other contractual stipulation. So that's a good example there. And then on the bottom, I'm sure that a lot of you have, and I think this is going to be an interesting category. I'm sure that a lot of you already have internal limitations that you've placed by yourselves, the board. So you've either designated funds to function as a long-term quasi-endowment, like a true donor endowment, or you've designated unrestricted funds for future purposes. So many of you may have designations surrounding like capital improvements or other rainy day funds. You might have designations from certain agreements that you have with partners in your organization for operations where you're building up funds for specific purposes. Those are all internal limitations. But I think the interesting thing here, though, is to remember is that if a creditor comes calling on some of these internal funds, theoretically, they should be available in that scenario. To fulfill the obligations of the creditor. But outstanding, kind of withstanding that, generally within this category, it's the board's discretion to keep these funds for specific purposes. So I think that the other thing too here that's important, and I'd ask Elizabeth's opinion on this too, but I think we've been talking a lot with our nonprofit community about if you don't already have internal board designated funds, or if you've been thinking about that, setting up that long-term endowment, this is probably a really good time to revisit those conversations and those discussions. Because the other thing too that changes here is that your organization's going to have to disclose more about these types of designations in your financial statements as a result of these standards. So the existing GAAP didn't really say much about what organizations had to do here, but the new GAAP under the standard does. So again, a really good time to put your heads together, talk about it in your committee meetings, figure out what makes sense for you here, because this is a key component of this liquidity disclosure.
Thank you. This is Liz. And one of the other things I would suggest is, in the boardroom, I think it will become increasingly important to have reports, perhaps not quarterly, but at least annually, of assets in these different categories, designated by, what is a financial asset that is available for general expenditures, what's restricted, what's reportable, etc., in a quick snapshot, kind of a dashboard way, so that the board can feel confidence that that both the reporting requirements are being met and the organization itself has a good handle on the health of its liquidity.
Yeah, that's very, very important. That's a great point. All right, so I think what we want to get into next is starting to set the foundation for what a disclosure might look like. And I thought it would be kind of cool to show you for those of you that haven't, been working on any kind of pro formas yet, or kind of looking at what your financials might look like under the new reporting model. This is a statement of financial position under the new reporting model. So the key change down there, you'll see with the net assets, the collapse there on the with and without donor restrictions. That's different from what you're currently seeing with unrestricted temp and permanently restricted net assets. So just wanted to point that out there. But up on the top there, you'll see that I've kind of stoplight highlighted the various different types of financial assets that we've talked about in the few previous slides that we've gone over. And I want to just spend a second here. The green assets that are highlighted, these are things, and again, just to kind of set the stage in terms of like analyzing what we need to talk about and discuss in these note disclosures. So these are things that, cash, tuition, this is an example of a school, that has tuition or other fees receivable, current contributions, so contributions that are being recognized in the 12-month period, short-term investments. Those are all things that, kind of when we think of the green status, those are all financial assets that are probably going to be liquid within that 12-month period. Now, there may or may not be some program restrictions, for example, on the contributions, but, we might assume there that it's going to be liquid within the next 12 months. A couple of things that we talked about on the previous slide that could make financial assets not available are highlighted there in orange and red. So the orange highlight is a long-term investment portfolio. So in this scenario, we might assume that most of those investments are going to be tied to your corpus on your endowment in this example. So that's not, you can't touch that. The piece of it that's in green up on top, the piece that's been appropriated for current use, we would assume in this example that that's the portion, that your organization that has identified out of that endowment portfolio, out of the accumulated earnings and capital change that is going to be used in that 12-month period. So just thinking in terms of that, on a financial asset such as an investment portfolio, because you could have different components to it. And certainly a lot of organizations, and I'm sure some of yours on the line here, have long-term investments that are not related to the endowment. I mean, they could be related to other specific types of internal designations or other purposes. So you kind of got to, analyze and pick apart the portfolio if you have several purposes for it. And then, other things that I mentioned on the other slide, like contractual obligations. So the certificate of deposit, that's a good example. In this particular case, it's restricted for bond reserves. So that's something that's not going to be liquid and available. And then any long-term contributions, again, you'll have to, kind of assess whether or not there's just time restrictions on those for purposes of receiving cash, or whether or not there's actual long-term program obligations that you have to fulfill according to donor wishes. So just kind of wanted to marry the previous slide that we just talked about with sort of, looking at it, from the financial statement perspective. Again, really just trying to set the stage here for the disclosures we're going to talk about. Again, you're not really considering the liabilities, any financial liabilities that you have in the analysis. You're really just starting with the financial assets. The next slide is just to show you a presentation of the statement of activities. We won't spend too much time here, but you'll just see the with and without donor restrictions there in the column. I just wanted to have that up for you to look at on the slide, but we'll continue to move on and start talking about our disclosures a little bit more. So there's two main components to the liquidity disclosure. There's a piece of it that's really qualitative in nature, and then there's the piece of it that's quantitative that deals with the numbers and the starting point of the financial statements, the statement of financial position specifically that we just went over. So in terms of your qualitative analysis for your liquidity disclosure, there's some bullet points here on this slide, many of which we've alluded to already about just what you need to consider in terms of drafting the liquidity disclosure, the qualitative piece of it. So I think first and foremost here, that top bullet point is whether or not your organization has a strategy for addressing entity-wide risks. So I know that many of you in your boards and in your board committees probably have subcommittees that are centered around risk, cash flow needs, all of those things which are part of the ongoing strategy. What you're going to do in the future as far as like programs, expansion, things of the like. That is something that's going to be that analysis that you already have, and any strategic plans that you already have, that you've already talked about in your board and your board committees, and management's been involved in those discussions. Those are really keys for information that are going to help with this disclosure. Because that also, as I mentioned before, those types of activities and that strategy also, alludes to how you're going to manage cash, any reserves that you're going to create or that you already have, things of the like when looking at liquidity. The second bullet point, a lot of that, the strategy, managing cash requirements, it doesn't have to be daily. For some of you, there's different periods during the year. Specifically when you're going through, like your annual, giving campaigns, or if you're going through capital campaigns, or, other aspects of your operations, that it's going to be, there's going to be different ways in how you manage cash requirements. So not necessarily daily, but certain times throughout the year, monthly, however your organization manages cash requirements is going to be a key to this analysis. We talked about liquidity reserves, whether or not you've got anything established already. We talked about identifying amounts that are not available to meet cash needs within the time horizon. So anything that's restricted, locked up, contractual limitations, any of those things that we spoke about on the previous slides. Board designated funds. So many of you, as we mentioned, you've probably got board designated funds for endowment or other purposes, but maybe some of you, and I've seen this with a lot of my clients, you've got rainy day funds essentially for general operating purposes that are available if needed. All definitely important components for this analysis. And then lines of credit, or other sources that are available and could be available in cash if needed. Okay, so let's look at what a really sort of high level, simple part of the qualitative liquidity disclosure would look like, taking into consideration the bullet points and topics that we've just discussed on the previous slides. So this organization, and the bullet that I mentioned about the organization's policy to manage liquidity, that doesn't have to be as defined or explicit or spelled out in this footnote disclosure as you might have it in other forms, like, for example, in your strategic plan. But just to put something in this disclosure that highlights it, that you do have a strategy and a plan. And in this example, it's just that, you've got financial assets structured to be available to support obligations as they come due. It could be something as simple as that. You could have a little bit more detail and analysis to it, but just something up there that kind of talks about your policy overall. And then if we move on, we've got some highlighted items there in this example that are important in this disclosure. So this organization talks about the short-term investment account. So that's comprised of a balance of securities that can cover 3 months worth of operating expenditures. It's completely liquid to pay for operating needs if needed. So if we just to kind of flash back here real quick to that financial statement that I showed you before. If we kind of marry that with the financial statements, because that's our starting point, that short-term investment piece that we're talking about is that 1.5 million there that you see. So that's the 6th item down under the current assets. So we want to kind of start setting the stage for the rationale for what is being put into the analysis and the disclosure. So similarly with the long-term investments, so this organization is starting out talking about the donor restricted endowment fund. So the first thing that they do there is they highlight that the piece of it that's related to the corpus is not available. It talks a little bit further and it references a specific note that the endowment has a spending rate of 5%. So this organization has made an appropriation from that endowment that's going to be available within the next 12 months. Now, remember, this is a quasi-endowment. So the quasi-endowment could be made available in its entirety if needed. So it differentiates, the footnote differentiates between the donor restricted piece and the quasi-endowment piece. So that's, again, very important when thinking about what you want to put in your footnotes. And then this footnote goes on to talk about limitations. So, we kind of said before to think about your investment portfolio in terms of what is in there and what is comprising the investment portfolio. So we've got donor restricted endowments, quasi endowments, and now it talks about limitations and availability on certain investment types that are in that portfolio. So it says that they have about 2.5 million that's subject to certain lockup restrictions that can't be available. So good rule of thumb here, good key to kind of remember is that if you've got investments in that portfolio that are in things like hedge funds, alternative investments, anything like that could potentially have a different measurement value at the reporting date, or if there's lockups or restrictions on when your organization can redeem those funds, even if those funds are not tied to an endowment, whether it's a donor restricted or a quasi endowment, you could have liquidity restrictions there because of those lockups. So it's also important for you to know, and again, this is a good conversation, and I'm sure your investment subcommittees of your boards have all talked about this for those of you that have large investment portfolios, but very good idea to understand what you've got in your portfolio in terms of the types of investments and how that could impact liquidity. Some of you, as you go through this exercise, some of you may think about the composition of your investment portfolio and may decide to rebalance or reallocate, or maybe look at your investment policy a little bit more closely in terms of what you need to have for liquidity purposes. So that's certainly part of this exercise and something that should be on the list to think about when going through this analysis. And then the last thing here in this disclosure is just the example of the credit line that this organization has, which looks like they have a line of about $500,000. Doesn't look like they have any draws on it, but it could be available if needed. So that's the qualitative piece, really brief example, qualitative piece of the disclosure. what you need to do and what you should do in your disclosure is you should pair that with the numbers on the face of the financial statements that we've talked about. So the starting point, as I mentioned before, is the statement of financial position. So this is the quantitative piece that sort of finishes the story from the qualitative analysis that we just went over.
Stacy, just to break in here, this is Liz, is on the last slide, to be clear, that's a footnote, right?
Yes, this is the footnote, an example footnote disclosure. Part of it is with the qualitative analysis.
Gotcha. Okay. Thank you.
Yep, great clarification. So the component of the disclosure that's going to be quantitative and numerical is going to be a subset that's going to reconcile back to the total assets on the statement of financial position. So qualitative disclosures give the meat, the qualitative narrative disclosure that we went over, it gives the meat. And it should give context to the quantitative information and the numbers that are in the disclosure. So that's really how it pairs together. So if we just look at the quantitative piece of this particular disclosure, kind of going on, you'll see there that the total financial assets, which are again would be taken from the statement of financial position. So this particular organization has gone through and identified their financial assets that we talked about at the beginning of our webinar today. So those include cash, receivables, investments, and CDs. So that's the first part of it. And then the second part of the quantitative disclosure analysis is going through the exercise that we talked about and carving out what is not available for specific reasons. So if we just step back to our financial statements, the 2.9 million in the contributions receivable that's in the long-term portion, that's the first thing that we're carving out, because there's definitely time restrictions on those receivables. There could also be purpose restrictions as well. So that's the first thing that's carved out here. The next couple of things that are carved out are the investments that we talked about in the qualitative analysis that are not redeemable. So those were the investments that we talked about that had the lockups and restrictions on them. The certificates of deposit, which are tied to the bond requirements, and then all of the endowment related investments. So both board and donor restricted investments. All of that is carved out to get down to a final total of financial assets that are available to meet the general obligations within 1 year. So you can see from this slide that this adds, so that the qualitative information that we went over gives context to these numbers. And then a user looking through the financial statements can say, okay, I know from looking at your statement of financial position that you have these financial assets you've identified, but because of X, Y, and Z, you have amounts that are unavailable. So really, at the end of the day, out of your total financial asset balance, you have 13.6 million that's available to fund expenditures. That's not tied up to any restriction, lockup, CD, any other contractual type of purpose. So hopefully this is all starting to come together and be a little bit clearer, and hopefully not scary. We definitely don't want it to be a daunting task or anything that anybody is worried about. So let's go over our next polling question.
So the second question is, how many of you believe your liquidity footnote may tell a different story than your financials? So is it yes, I believe it will tell a different story? No, I believe the face of the financials are transparent with request to liability or liquidity, or is it I'm undecided? It's okay. We'll go ahead and give everyone just a few moments to put in their answers. Okay, and we'll go ahead and close the polls.
We've got some interesting Interesting responses. So it looks like 29% of you believe it will tell a different story. Okay. I'm interested, the 29% of you, I'm really intrigued. I'm interested more about your operations and, sort of understanding the why, because I think that's unique to each organization. It looks like almost half of you said that you believe the financials are transparent, and got a portion of you that are undecided. So those of you that are undecided, definitely good times to start talking and looking through this analysis a little bit further to kind of figure out whether or not you've got a little bit of a different story. And we put that polling question in there because we wanted to show you that one example, just kind of a really simple example, but we put the polling question in there because it's a good segue to the next 3 examples that I'm going to show you. So the next 3 examples are actually going to take a school and compare and contrast 3 different sort of stages that the school is in, if you want to call it that. But the one example that we're going to look at is a school with a large endowment. The next example that we're going to look at is a school that's gone through a new construction project. And the third one is we're going to look at one that has a very liquid balance sheet. Now, before we, before we get into the analysis here, I think it's important to note that like any of these examples can definitely translate to any type of organization that you are involved with. So if you're a member that's involved with a social service organization or an organization that's in healthcare or religious space or arts or museums, performing arts, anything of the like, definitely these examples can apply to those types of organizations as well, because no doubt you would have transactions on your books that are related to like endowments or big projects, or you could just be really liquid. And so the thing that we want to point out is that all 3 of the scenarios are going to point out a very different example of liquidity, status of liquidity at the end of the day. So the first one that we're looking at here with respect to a big endowment school. So if you just, a couple of things to highlight here, you can see the cash and cash equivalent balance isn't very large. This school has, several other financial assets, but if you look at the long-term investments, which is about the 7th row down, so it's $55 million. So that's pretty substantial. It's a significant portion of the statement of financial position. If you kind of drop down to the net asset section, you can see there that, you can make the assumption that probably a lot of those investments are going to be locked up in a donor restricted endowment or maybe an internal designated endowment. So just a couple of things to note here on the statement. So let's move forward. As we showed in the last example, you have to go through this qualitative analysis first. So you've really got to figure out, what you have and what's available and what's not. So couple of key highlights there on the second paragraph, the contributions, talk about the contributions receivable and what is receivable for a campaign that's ongoing. And so that's anticipated to be $1 million. And then the next paragraph talks about and analyzes the short-term investments. So talks about the amounts that are going to be available that the board intends to expend, $5 million within 12 months. It talks about the board spending policy, the amount that's been appropriated for expenditure, which is the $1.5 million that's in short-term investments. So all things that we saw on the previous slide. And then this school has a certificate of deposit that's tied up on a note, so that's not going to be available. And then they go on to look at their long-term investment and portfolio. Again, the highlights there that are in bold, they've got limitations on long-term investment funds. Those total about $47 million related to the donor restricted endowment fund. So we surmised on the last slide that a big portion of that investment portfolio was probably tied up to the donor restricted endowment, and it looks like that's the case. And then it looks like this school has a line of credit available. So that's $3.4 million, the second paragraph from the bottom there. All right, so here's the big reveal. So we started with all of our financial assets. So same exercise as we did before, going through the balance sheet and identifying what the financial assets are, cash, receivables, investments, CDs. Total financial assets are $68 million. But if you look through the amounts that this organization has carved out as being unavailable, and I like this example because they've actually bifurcated the amounts that are unavailable between contractual, donor-imposed restrictions, and then internal restrictions. So all of the things that they've talked about on the previous slide, the contributions, the investments, the portions that are designated for the internal endowment. And if you get down to the bottom, out of 68 million of total financial assets available, this organization really only has about 11 million that's available to meet cash needs for general expenditures within a year. It's because they've got all those lockups, restrictions, donor-imposed restrictions, things of the like. So you can kind of see how through the analysis, there's a little bit of a different picture at the end of the day that isn't necessarily completely transparent when you're just looking at the statement of financial position. So if we look at that compared to, and again, a school with a capital project, so new construction, and again, just want to reiterate, this can apply to any of you that have projects that you've gone through. So, major building maintenance and repairs is a good example, things like that, the big project that you've gone through. So just a snapshot of the statement of financial position here. We've got lots of financial assets. We've got cash, tuition, investments, probably scoping prepaids and property and equipment out of that, as we mentioned before. We've got a small balance of donor restrictions in the net asset section, but most of it's related to the without donor restriction. The other thing I wanted to note there too is that you can tell in the top line, the cash and cash equivalent, that balance has declined significantly from the previous year. So we're imagining that a lot of the cash that was sitting there funded the construction project that was happening from XO to the X1 year there. So keep that in mind. And if we look at the first part of the disclosure for the qualitative analysis, so as we suspected, this particular organization just completed a project related to a new gym. It was $14 million, so that is going to account for most of that significant decrease in the cash balance, but the increase in the property and equipment. This particular school talked about the tuition and fees that it's anticipating collecting in the upcoming year. And that's totally fine to talk about in your analysis, even though it's not directly related to a balance in your statement of financial position. It's cash flow, right? And that is a part of liquidity and cash that's going to be expended in operations. And then the second bullet that's highlighted, or second set of text that's highlighted, is the investments. So this particular school has about 5.5 million that's related to the endowment to provide financial aid or scholarships to its students. So that's not going to be utilized. It can't be touched. But they've got 1.5 million in earnings that can be used. And they've appropriated it looks like only about 275,000 of that in the current year. They have no lines of credit, so no other sources of available funds. So let's look at what their quantitative disclosure would look like. So total financial assets are 8 million. The key thing that they have that are not available is the investments, so that are related to the donor endowments. So this particular organization, out of 8 million in financial assets, has about 1.4 million that's available to meet cash needs for general obligations. So again, a little bit different picture when you're just looking at financial assets on the statement of position versus what's actually available. School in a different scenario, right? They just went through a huge expenditure for a major capital project. And then the third example is a school with a very liquid balance sheet. And again, this will apply to all of you who are in different organizations, social services, education, healthcare, whatever type of sub-industry you're involved with. So a couple of things to note here, 2 top line items on the statement of financial position, very large cash and investment balances. Those are the 2 key financial assets, significant financial assets that are in the financial statements. If we drop down to the bottom there in the net assets, we can surmise that most of those financial assets are probably unrestricted without donor restrictions, because there's only a small piece, about 5 million or so, that looks like it's related to donor restrictions. So this is a very healthy, unrestricted, if you will, balance sheet or statement of financial position. All right, so let's look at the qualitative piece of it. So there, again, this school is talking about its policy, gives a little bit more detail. I said before, you can put in, it's up to you. It's up to your judgment, your organization, to put in however much you want on your strategy and sort of your policy, your overall policy. So they talk a little bit about that in the second paragraph in this slide. The third paragraph on the long-term investments talks about the delineation between the donor restricted and the board quasi-endowment. And again, like the other examples, talks about the quasi-endowment that can be available in its entirety if needed. This particular school also talks about tuition and what it anticipates to collect in the upcoming year that will be used in operations. It goes on to talk about its contributions, which look like they'll be collectible and they can support operations of the school. And they do have a $5 million line of credit that's available. So again, all very liquid items in the qualitative analysis. So let's look at financially, on the financial asset piece, on the quantitative piece, how that shapes up. So you got total financial assets of 49 million. So again, that primarily includes the cash and investment balances. The only piece of that they talked about in the previous footnote that was restricted for donor purposes related to the investment was 3.8 million. So pretty small, pretty insignificant. And the board designated pieces of it are about 8 million or so. So on this example, you can see that the total financial assets available are 36 million out of that 49 million of total financial assets. So again, you can see that in the three different, sort of scenarios or stages that these examples are in, create a very, very different picture when we're looking at financial assets available. A very healthy balance sheet doesn't always mean liquidity in terms of resources and funds available, because again, you could have lockups with endowments and other designations and restrictions. Okay. Elizabeth, what are your thoughts on these three comparisons?
Well, it certainly underscores the fact that the importance of having the quantitative and the qualitative disclosures be in sync. Mm-hmm. So that's one thing that a good takeaway, I think, is that board members should be checking for that in particular, because it as the voting showed, there can be some mismatches there.
Yep, absolutely. All right, so let's do our third polling question.
So the question is, identify who you believe will be impacted stakeholders as a result of this new disclosure. Is it the board of the organization, donors and funders, lenders, A and B, so the board of organizations and donors and funders, or all of the above? Okay, and we'll go ahead and close the polls.
Awesome. So that was a landslide. So it looks like 96% of you said all of the above, and I would agree with that. I think we would all agree with that. Definitely internal and external stakeholders, including the board, management, lenders, funders. They're all key stakeholders in this new liquidity analysis and disclosure. So now that we've showed you, we've kind of gone over the basic highlights of this portion of the standard related to liquidity. We showed you some pretty robust examples and disclosures. Again, any of you that wanted some additional tips or templates or things that you could work into your organization or things that you could talk with your board or your management on, happy to share that information with you. But just to leave you with, some implementation tips here that I think are important. Each of you is going to have to determine the impact that it's going to have on your financial statements. If you're worried at all about, these new standards presenting a picture of your organization that you're, worried about, or that may make you seem illiquid, or you believe has some other negative connotation to it that you didn't anticipate or didn't intend, make sure you talk about those things. If you think that any funders that you have or partners that you work with at your organization might have the same concerns, talk to them about it. Make sure that everyone is on the same page about, what you're going to disclose and what picture you're going to present and what story you're going to tell, because it is very important. Management and the board, definitely the board and or finance committee should be involved. I mentioned at the beginning of our presentation that we've been, as a best practice, having management and board go through the implementation together and just make sure that they're all on board with what is going into the financials. If you don't have reserves, good time to discuss that. Talk about what you need there. We talked about evaluating the impact of the footnote, both internally and externally. If you need any changes to like your chart of accounts, your reporting capabilities in your system for, correct presentation, anything of the like, consider that from like a, kind of a nuts and bolts accounting process on whether or not you need changes there. Those of you that have significant transactions like significant endowments, investments, things of the like, where you're utilizing software systems, not only for the accounting, but like also maybe for the endowment tracking piece of it, make sure that you've considered the utilization of those systems in the reporting that you need, and that you're going to have adequate support there from the system perspective to get you the reports and the numbers. Elizabeth also mentioned at the beginning of the presentation, the board reporting, and that's a very important consideration here, especially with your software tools. All right, so let's do our last polling question of the day.
Okay, so the question is, who should be involved in the content of the liquidity footnote? Is it the board, finance committee of the organization? Is it management, lenders, funders, or A and B? So the first.
All right. Well, it looks like we've got most of you saying management, about 40 of you saying 4% for the board and finance committee. I think we tried to trick you guys here.
And we'll go ahead and close the polls.
Yeah, so definitely management should be involved, board and finance committee, to the extent, however that you think is necessary within your organization should be involved as well, key stakeholders internally. Okay, so just to leave you with a couple of effective date items here. So as I mentioned earlier, the nonprofit reporting standard as a whole has 5 different key components to it. We focused on liquidity today. On the liquidity piece of it, for your organizations that have not early adopted this standard, you have a little bit of a break here. So the liquidity disclosure itself is really only required in the year of adoption. So what I mean by that is, if you're a June 30, 19 year end, or if you're a 12/31/18 year end, this standard applies to you now. You have to implement it for those reporting periods. But if you are showing comparative financial statements, what that means is that you don't have to go back to the comparative period and do a liquidity presentation looking forward to the 12 months. You really only need to do the liquidity analysis in the year of adoption. So that would either be your year ending 6/30/19 or 12/31/18. And remember that you're looking out to a 12-month period. So you have to look out to either 12/31/19 or 6/30/2020 in terms of your analysis and availability of your funds.
Okay. Awesome. So
this This is Liz Fetter again from NACD. I just want to thank everybody for logging in and going through this very important high-level review of the standards that are now in place for nonprofit liquidity reporting. NACD's goal is to bring to you very timely, important educational, both webinars and in-person sessions on topics for both for-profit and nonprofit board members. The key takeaways I got from Stacy's review of the material are that, one, it's really important to be asking the right questions in the boardroom, a key element of appropriate and a high standard of governance for board members. Part of that will be, I think, the reporting that I mentioned, getting a board dashboard on liquidity, checking to make sure that the qualitative and the quantitative messages in the reporting are in alignment. And then finally, really digging down into, with management, into liquidity shortfalls, obviously, or any issues with the operating management of the company or the nonprofit organization that may come up through this actual disclosure. It can be quite revealing, and that obviously is a key element of the governance role of the board.
Perfect. And thank you everyone for joining. Just as a reminder, everyone will get a link to the recording of the presentation and today's webinar within the next 24 to 48 hours. So thank you for joining.